Hello, everybody. Welcome to Intermediate Accounting 17th edition video solution walkthrough for Kiesel, Weingen, and Warfield exercise 1418. Hopefully I won't have to do this in 2 takes, but we'll see if we can get it in 1. The textbook authors are Don Kiesel, Jerry Weingen, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons, all rights reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. That was a mouthful. Let's go right over to it. Okay, so we're now on exercise 1418. And let's just bring this down over here. So on January 1st, 2020, Avery borrowed and received $400,000 from a major customer, evidenced by a 0 interest-bearing note that's due in 3 years. Okay, so right off the bat, they're getting money. We're issuing a note payable, so we know that that's happening, but there's something wrong here. As consideration for the 0 interest-bearing feature, Avery agrees to supply the customer's inventory needs for the loan period at lower than the market price. The appropriate rate at which to impute interest is at 8%. So let's do the basics first. And if you want to check out my video where I, went through and explained, I kind of bumbled through it like an Englishman, like a Hugh Grant, something like that. You can check out exercise 1417. Hugh Grant is, well, I don't have the divine incident, but yeah, right over here. So I'm not going to go any further with that. So on 1/1/20, we know we're getting cash of 400,000, and I'm going to be crediting notes payable. However, we do know though that's not really real. So the amount, the note amount that I'm going to be repaying back in 4 years is 400,000. So what I'm going to do is I'm going to discount this by using present value of $1. This is going to be 3 years at 8%. So it tells us over here that this is me 3 years at 8%. So right over here, present value of $1, 3 periods at 8% is 0.79383. So over here, my present value of the note is going to be 400,000 times 0.79383 or 317,532. So I know that I have to show the difference between the note amount and the present is going to be my discount on notes payable. My discount on notes payable is going to be 82,468. So I'm going to have a discount on notes payable of 82,468. Now, you might be saying, or you might look above and say, oh, unearned sales are right. That's what we're going to be recording. So assume that Avery's product to this customer will occur evenly over the next 3 years, right? So I'm going to have over here unearned sales revenue. And that's really the reason why I got the discount or I got the interest-free loan, is because I'm giving a break below market prices to this customer to record loan received from customer. Okay, so that's my initial entry. On 12/31/20, I have to do 2 things. Okay, so the first one I'm going to be doing is I have to show the revenue, the sales revenue being earned. Over here, it was assumed sales of Avery product will occur evenly during the 3-year period. So right over here, I'm going to debit unearned sales revenue, 82,468 divided by 3, and then I'm going to be recording sales revenue. Okay, so this is to record sales revenue. And this entry I'll be making every single year for the next 3 years. So this is 82,468 divided by 3. Now, I also have to amortize this discount on notes payable to interest expense. So I'm going to be crediting discount on notes payable, and I'm going to be debiting interest expense. Okay, so the way I'm going to go through and do this is what I've been doing before. So on 12/31/20, My note payable amount is 400,000 less my discount. My discount is going to be 82,468. My note payable carrying value is going to be 317,532. My interest rate is at 8%. So my interest expense is going to be 317,532 at 8% or 25,403. Okay, so, and as you'll see me on all my videos that I've been doing for this, I always want to make sure that it works. So there we go. It's a 3-year note. Okay. So again, if I, and I'm just kind of editing this a little bit. You're seeing the action, the fun behind the scenes. So my discount on notes payable started out over here with a balance of 82,468. I amortize the first part over here to interest expense. Let's go ahead and do this for the final 2 years. My discount is now going to be 82,468 minus the 25,403. And so when I take this, I get 27,435 and then 29,630. So after I've gone through and I've done this over here, these pretty much are going to zero out by the time I go through and pay the note, which is what I'm looking to go through and do. Because whenever I'm paying something off, like a bond or whatever may have you, the discount premium, whatever may have you, needs to go down to 0. Okay, so that's kind of how we're going through and doing this one over here. So that was exercise 1418. And again, I want to thank you, Wiley. Please don't forget to like and subscribe. If there are other solutions you would like me to do with the Wiley textbook, they've been kind enough to allow me to create public videos on their 17th edition textbook. Feel free to reach out and put your question in the comments. I will see you soon and have a great day.